Hello everyone, welcome back to this new video of Sapphire Talks English. Now let me start this video with a very simple question. What does a fight between America and Russia have to do with the petrol in your car, the value of the rupee, and even your stock market portfolio? The answer is quite a lot actually. Because behind all the headlines about America, Russia, and Iran, there's one important word, and that word is oil. And India happens to be sitting right in the middle of this geopolitical oil game. On one side, the United States want to put pressure on countries like India that continue buying Russian oil. On the other side, Russia remains one of India's largest crude oil suppliers. And then we have the Iran US tensions, which are threatening oil supplies to one of the most important energy choke points. That is the Strait of Hormuz. Now look at the numbers. As of 18th August 2026, Brent crude had crossed $91 per barrel, and India's dependence on Russian crude has actually increased sharply. During the period April to July 26, Russian crude accounted for 43.25% of India's crude oil imports. So here is a million, or should I say $1 billion question. Can India continue buying cheap Russian oil while simultaneously managing its relationship with the United States? And more importantly, what happens to you if oil remains expensive? Because geopolitics may be happening in Washington, Moscow, and Tehran, but the bill eventually will come at your doorstep. Now, let's understand some basic economics here. India imports a substantial portion of its crude oil requirement. So, when international crude oil prices rise, India's import bill also rises. And this creates a very interesting chain reaction. Let's say, like falling dominoes. Geopolitical tension rises, oil prices go up, India's crude import bill goes up. India suddenly needs more US dollars to pay for the imported oil, so the demand for dollars also increases, and this puts a downward pressure on the rupee and the rupee weakens. And suddenly, the same barrel of crude, which was already expensive in dollar terms, becomes even more expensive when converted into rupees. And then comes the next problem, that is imported inflation. So, one geopolitical conflict thousands of kilometers away can eventually affect your household budget here in India. And this isn't just a theory. India's imported crude bill has already risen sharply in financial year 26-27 despite lower import volumes because international prices were high. And now comes a very interesting twist. Russia is supplying record volumes of crude oil to India. But at the same time, Russia started importing gasoline, that is what we call petrol, from India because Ukrainian attacks have disrupted Russian refining capacity to a very large extent. Think about how strange as well as fascinating this is. India is buying crude oil from Russia, and Russia is buying petrol from India. Geopolitics has officially now become one giant supply chain group project. And the funny part is, nobody seems to have read the same project instructions. But jokes apart, this tells us something very important. Oil today is not merely a commodity, it has become a strategic weapon, an economic weapon, as well as a diplomatic weapon. Now let's bring down this geopolitics to your wallet. The first major impact is on the Indian rupee. On 18th August 2026, Brent crude was above $91 per barrel, while the rupee was around 95.68 rupees for 1 US dollar. The RBI has also reportedly been intervening in the forex market to support the rupee. But why does oil have such a strong relationship with the rupee? The answer is quite simple. India buys crude largely in US dollars. So when oil prices rise, India needs more dollars. The demand for more dollars puts downward pressure on the rupee. So the chain goes like this: oil up, dollar demand is also up, but the rupee is down. And when the rupee falls, imported crude becomes more expensive in rupee terms. Now, one might say, fine, oil has become expensive, so petrol prices will go up immediately, right? Well, not quite. Petrol pricing isn't a simple formula where crude goes up by $5, petrol goes up by $5 also. If only economics were that easy, all of us hope that, right? The final retail price depends upon several factors: international crude prices, refining margins, rupee dollar exchange rate, central and state taxes, and the pricing decisions of oil marketing companies. For example, according to PPAC, petrol in Delhi was 102.12 rupees per liter on 31st July 2026. So don't expect any movement in crude oil to be immediately reflected at the petrol pump. But if crude stays high for a prolonged period and the rupee remains weak, then the pressure becomes even more significant. And now this brings us to our favorite question. Crude expensive in dollars plus weak rupee is equal to double trouble, right? The answer is yes. Now comes the question that every investor is also interested in. What will happen to the stock market? Honestly, you can tolerate a little pain at the petrol pump, but show an investor 10% fall in his or her portfolio, and suddenly geopolitics becomes a personal matter. So let's understand which companies could come under pressure when oil prices rise. Companies that consume significant amount of energy or petroleum based inputs will see their input costs rising. So think about aviation, paints, chemicals, tires, logistics and airlines. And several consumer companies, if input costs rise faster than the selling price, they can have their profit margins squeezed. When profit margins are squeezed, the investors start asking one uncomfortable question. Are earning estimates also going to go down? And once earning expectations go down, stock valuations also come under pressure. But remember, every market story has two sides. There can also be potential beneficiaries. For example, oil producers and upstream companies could benefit from higher oil prices. Some domestic refiners could benefit depending on their margins and operating environment. Companies with strong pricing power may be better positioned because they can pass on the higher prices to the consumers. And exporters may receive some benefit because of the weak rupee. But there's a catch. If exporters also heavily depend on imported inputs, the benefit of a weaker rupee can get partially or even completely cancelled out. So investors should not simply think that oil is up, so the stocks will be down. You have to look at the entire business model. How much oil does the company consume? Can it pass on the higher cost? How strong its margins are? Does it have imported inputs? And how sensitive are its earnings to currency movements? That is where the real analysis should be done. And this is why the current situation is much bigger than actually petrol prices. The story is about America, Russia, Iran, and oil, the dollar, the rupee, and ultimately the Indian stock market. Because in today's world, interconnected world, wars are not fought only with missiles and soldiers. Sanctions are weapons, tariffs are weapons, currencies are weapons, and increasingly oil has also become a geopolitical weapon. India is standing right in the middle of this geo-economic chessboard. And the big question is India with America, or is India with Russia, or is India simply minding its own national interest? And that, ladies and gentlemen, is the real story behind the oil war. It is not just about the prices of petrol. It is as much about rupee, inflation, corporate profits, interest rates, and the value of your investments. So friends, I'll conclude here. If you have found this video useful, please like this video, share it with someone who follows the economy or the stock market, and most importantly, subscribe to our channel for much more explainers like this. Thank you for watching. I'll see you in the next one. Jai Hind, Jai Bharat, Vande Mataram.